They're planning these new Mac processors for introduction as early as 2021. I don't know whether then we get some new Macs or things like that, but it's always about the cycles, and it's always about needing new PCs and all of that. Now let's get straight to the Bloomberg First Word News. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. One Republican senator predicts that President Trump will get on board with a bipartisan $908 billion package for coronavirus relief. Senator Bill Cassidy told Fox News that Senate Majority Leader Mitch McConnell will back it too. Cassidy is a member of the group that's pushing the measure. President Trump's lawyer, Rudy Giuliani, has tested positive for the coronavirus. According to reports, he's been hospitalized in Washington. Giuliani's son says he's getting great care and feeling well. Giuliani has been leading the efforts to overturn the results of the election. And in China, exports jumped in November by the most since early 2018. That's pushed its trade surplus to a monthly record high, and it underlined how global demand for pandemic-related goods is helping the Chinese economy rebound. It's another potential blow to New York City's stature as the home of the U.S. financial industry. Goldman Sachs is considering plans to move its asset management unit to South Florida. Goldman's success in operating remotely during the pandemic has persuaded the firm's leaders that they can move jobs out of New York to save money. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine.
Thank you so much, Ritika. Now, the market is firmly looking, of course, at what's happening with Brexit. I was trying to look at whether technology stocks are being whipsawed because of Apple preparing the next Mac chips with an aim to outclass even their higher competitors in 2021. But let's focus, first of all, on Brexit. I know Lisa and I have been really wanting to talk about this. We know that a British official warned that talks over a future trade deal with the EU could collapse as soon as today. This could be political posturing. It could be talking to their constituencies back home, but certainly pound is moving on the back of it. You can see against the dollar at 132.68, against the euro, which is what a lot of pros look at, it's at 121.06. I think it's the wrong way around, but we'll look at that a little bit further. And then if you look at European stocks, they're down 0.4%, but they're still close, Lisa. And this is a point that you keep on making, which is, of course, something that we always have to keep in mind. They're so close to the record highs.
Yeah, exactly. It's this sort of softness is barely softness when you look at where we're come from. Just to give you an update, Apple share is nearly flat on the session ahead of the U.S. Open after reports that they are going to create their own chips, taking business potentially away from Intel. Intel clawing back some of the earlier losses, but down nearly 4% in pre-market trading. But to your point, Francine, all of this uncertainty, Brexit, trade tensions, it's all adding up to a 0.4% decline in U.S. equities ahead of the open. A pretty de minimis decline when you take a look at the near-term record highs. If you take a look also at what we're seeing in the currency market, also a little bit of risk off. You're seeing a little bit of dollar strengthening versus the yuan based on some of those trade tensions and perhaps putting off some of that better than expected trade data overnight. Italian 10-year yields at an all-time low, 0.513%. The ECB backstop is real. Copper futures coming off their post-crisis highs at $349.80. Joining us now, Jens Nordvig, Exante Data founder and chief executive officer. Jens, I want to start with Brexit because you promised us bottles of wine. Should we still be talking about Brexit a couple years from now, which we will, and we will be enjoying our wine. Jens, I want to start with this idea that we are seeing sterling selling off versus the dollar today, the most at one point since March. Is this a buy the dip kind of moment, or do you think that this is a harbinger of what's to come?
I think into these political events, it's very often the case that when you have a very strong consensus in one direction, you have some volatility into the sort of final negotiations. We've seen around Brexit here. We've even seen around this lame duck stillness in the US. When the consensus get too sort of swayed in one direction, that is a dangerous moment. That's what we've had over the last couple of weeks, really, that people got very optimistic that a deal was pretty much done, and now we have some serious wobbles. And it seems very much like a 50-50 situation now. It's on the one hand, like, is this deal really going to be derailed by issues like fish, or is this more a situation where you have the different negotiations need to look tough they need to look like they're really squeezing the juice out of this negotiation to sell it at home, right? And I think there's certainly an element of that. So that's the sort of hopeful interpretation. But this is coming down to the wire now, and we only have a couple of days left to get a deal done before it's too late, essentially, to get the formalities sorted out.
Jens, you put it so well, 50-50. Is this deal going to be derailed by fish? So what happens to the pound if the 50 happens or the 50 happens, if they don't come to a deal or they do?
I think if you look at euro sterling, we've already retraced a meaningful amount from the lows, meaning that the pound being stronger in that cross. I think we can probably move another 2-3% quickly if this deal falls apart, right? And that's sort of the knee-jerk reaction. Then we have to think about what does this really mean, right? So what we're hoping for in the market now is that we have this so-called skinny deal that essentially sorts out the goods part of the relationship. But we've never had anything on the table that sorts out the services aspect, the hit from lack of access to the big service market in the European Union. And that would be really the long-term consequence. That was always in play, right? So sort of you have a two-phase thing where we have to deal with whether we get the skinny deal or not. But the longer-term consequences in terms of the service sector is always going to be there. And that was always going to be the big hit to the UK economy in 2021.
Jens, what does the UK economy look like in 3-4 years? And actually, what's unclear is what kind of trade deal they'll get with the US, depending on whether they get a deal or not. But that's largely irrelevant at this point. What they do with taxes, given it's also one of the countries that has fared the worst with COVID-19.
Yeah. So I think on the U.S. trade deal, there's not much going on now. Like we've had some sort of big headlines that there was going to be something between the UK and the United States, but there's not really anything concrete going on there. So that's a long time away before we have anything positive on that front. So it really comes down to what are the specific sectoral impacts on the UK. And as I mentioned, obviously the service sector is going to be in having serious issues, and we can already see in the financial sector, right, there are a lot of different banks that are moving trading to Paris and other European cities. So that process is already in motion. And then there's obviously a COVID shock that the UK have to deal with in a very severe way. And if I was going to come up with a positive angle that I think is relevant for a lot of economies, like once we have the vaccines, there are certain sectors that are going to open up, right? So tourists are going to start to come back to places like London and New York, where I'm based, and that's going to be a big factor. So that could be really important for 2021 if we look at the second half of the year, where presumably a lot of people will be vaccinated. But that is sort of a 1 to 2 year dynamic, whereas there's some of the Brexit dynamics that are obviously multi-year dynamics going beyond just a 2-year cycle.
But Jens, you have, the Tories in charge. It's a fixed term for the moment. Is there a danger that they go back to austerity to make a difference compared to the rest of the nations? And, what do we do about UK debt?
Yeah, so it's actually interesting. So we, at Exante, we're actually starting a public blog today. It's going to be called Money Inside and Out. And that's something we're launching. It's actually to address this issue that you are mentioning now. Like we have these big monetary policy issues out there. Doesn't matter how much debt we have. Is there a limit to how much monetary financing we can have and so forth? And the UK has been one of the countries which have sort of seen the most volatility in the fiscal position over the last decade or so. So this question is really relevant. Is there a point in which investors are going to say, okay, this fiscal policy is ultimately unsustainable. We don't believe that this path is something that is really a sound policy. Can we get to a situation where currencies start to trade like they do in emerging market space, where they really view monetization as a negative? And I think in the UK's context, if we have all these shocks hitting at the same time, it is something that comes into play, and people who are involved in sterling should think about that as a tail risk.
All right, thank you so much, Jens Nordvik of Exante Data, staying with us, and we'll talk a bit about the U.S. Lisa, I'm more and more suspicious that Tom took a day off just so he doesn't have to talk about Brexit. Yeah. Up next, we will talk about Brexit with the London mayor, Sadiq Khan. We'll ask him also about COVID-19 and when tourists are back in the city. This is Bloomberg.
we have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. Apple is looking to outperform Intel's fastest chips. It's planning a series of new Mac processors for introduction as early as next year. Apple engineers are working on several successors to the M1 custom chip. That was Apple's first main processor that debuted last month. If they live up to expectations, they'll outpace the performance of machines running Intel chips. As early as this week, Facebook will be hit by federal and state antitrust lawsuits. Bloomberg has learned they'll accuse the social network of abusing its dominance and thwarting competition. The lawsuits will be filed by the Republican-led FTC and by a group of state attorneys general led by New York's Letitia James, who's a Democrat. And the pandemic has taught independent investment banker Paul Taubman a few lessons. The founder of PJT Partners sat down with Bloomberg for a rare interview.
The big lesson is liquidity. My hope is that companies will rethink what an optimal capital structure is and not price it to perfection or to the expected case, but will think a bit more about the tail risk and what can happen, because we're all seeing these black swan events happen with alarming frequency.
And that is your latest Bloomberg Business Flash. Francine, Lisa.
Thank you so much, Ritika. Later today on Balance of Power, Rufus Yerxa, National Foreign Trade Council President. That's at 12:30 p.m. in New York, 5:30 p.m. in London. And coming up, we're going to be talking about tea clippers from New York and London. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter, and This is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is Bloomberg Surveillance. I'm Lisa Abramowitz in New York, Francine Lacroix in London, Tom Keene brining turkeys, going hunting with Vet Bill, and otherwise avoiding Brexit. Still with us, Jens Nordvig of Exante Data. We were talking about consensus trades earlier, this idea that there would have been so much consensus that there would be some deal on Brexit, that's what you're seeing today as sort of a cooling in that. You're also seeing a consensus about a weakening dollar. Do you think that that has gotten overplayed as well?
So I think certainly from a short-term perspective, we can see it in all the different positioning indicators that we track, that the CTAs are very short dollars, macro funds are very short dollars. So there has been a bit of a froth. I think if you look at it from a medium-term perspective, typically the dollar moves in sort of cycles that are driven by global growth, right? So the key thing that's going on right now from a medium-term perspective is, are we actually having a sort of growth recovery that is linked to the vaccines being deployed on a broad basis? If that's the case, then probably the medium-term trend is a very powerful one, and that warrants sort of less tactical trading. But it doesn't mean it can't be painful for a few days if we have bad news like this or anything other thing that's going to generate risk aversion.
Jens, what does that actually mean for dollar? Are we going to see a significantly weakened dollar from here?
I think the most important variable for the dollar is really what's going on with global growth. That tends to dominate, for example, what's going on with U.S. monetary policy. And therefore, I think having a meaningful move is very possible in this cycle. Also keep in mind that we've been in a strong dollar environment really since 2014, right? So we've had a 6-year period where the dollar has traded very well. We've gotten to strong valuations, right? So the dollar has now been weakening for about 6 months. But there's a lot of positions out there. For example, European real money investors have accumulated a lot of US dollar assets. It takes time for them to hedge those assets better. And I think we're only sort of halfway through this process of hedge ratios shifting. And that means that this dollar move has legs unless something bad happens on the way. Like the worst case scenario, I think, is that we have some bad news about the vaccines not being effective. That would really shake the notion that global growth is recovering.
But Jens, what about euro dollar? So could we reach 125 on euro dollar, and how problematic would that be for the ECB? Could they do something about it?
Yeah, so I'm getting that question, if not daily, then very, very frequently. And it's true that obviously from the ECB's perspective, they want to get inflation higher. They're way, way below their targets. So stronger currency is not helpful. But on the other hand, I think the Europeans also want to make sure that there is a degree of coordination globally around not interfering in currency markets. So it's very hard for them to do something that's too explicit. And if you think about it, like what is a very strong level of the euro, right? In 14, we traded 140. Like the levels we've been getting used to in the last 2 years are very, very low levels, and therefore a level to 125, I don't think is something that's totally game-changing for the ECB. And I don't think that you can say, okay, I don't want to be long the euro at all just because of that ECB concern. I think there are other forces that can dominate any short-term rhetoric by the ECB on this front.
Well, Jens, what could the ECB do if they wanted to weaken the euro?
Yeah, so I think the most effective instrument that they have that could drive the currency are the interest rates themselves, right? But it's incredibly controversial to cut deeper and deeper into negative. And there's a reason why the ECB has not been using that instrument for a while and has been focusing on the QE. And I think, and we think in the company, certainly that PEP expansion is the way forward for them now, and that's what they're going to do. We think we've seen the last rate cut essentially in terms of the official rate and the deposit rate essentially. And this means that they can't do that much. The PEP expansion is not going to be that forceful in terms of the currency. Really, if they want to do something, it will be cutting rates further, but that is viewed as being too costly for the banking system at this point in time.
You know, it's interesting. In the past, a bigger debt load would indicate a weaker economy, or at least would potentially weaken the currency. And yet here we have that $2.2 trillion European Union plan that's being discussed. Will that actually strengthen if passed? Would that strengthen the euro, or would it weaken the euro?
I think it would absolutely strengthen the euro. I think we saw it very clearly in the May to July period, right, that the European Recovery Fund idea was a major reason why we moved from 108 in the euro to 118, right? And it has to do with the fact that the European Union, the euro was always seen as being weak because there was no common fiscal capacity. And this is one step in the direction of building common fiscal capacity. And that should strengthen the growth prospects and should enhance financial stability. So all those issues are actually positive issues, and they're positive for the euro as well.
Jens, what do you do with renminbi right now? So given where we are in U.S.-China, President Trump trying to maybe box in the Biden administration, although that could actually backfire because it gives him more leverage with the country. But how do you view on China and renminbi?
Yeah, well, so there's some really positive things going on in the Chinese balance of payments. For the first time ever, we have very significant inflows into the Chinese bond market. That's number one. Number two, Chinese tourists are not allowed to travel anywhere. So the money they used to spend globally is now being captured in China itself. So there's some big positive shocks to the Chinese balance of payments that allow the Chinese currency to strengthen. So the big question now is whether they're actually intervening in the market. So we had interesting data today. The Chinese currency reserves gapped higher, 50 billion in the month of November. So that could be a sign that they're starting to intervene. Some of our proprietary day-to-day models of intervention have shown a pickup in essentially FX buying, Chinese currency selling by official or semi-official institutions in China. So perhaps we have this sort of fundamental positive backdrop in China, but perhaps they're also starting to essentially engage in their own currency market again in a way to avoid that appreciation. So that suggests we're going to have a sort of grinding move as opposed to like a gap stronger.
Fascinating, Jens Nordvig, Exante Data founder and chief executive officer. Interesting to see how China on the margins is getting that uncomfortable with the strengthening yuan. Coming up on the simulcast, Federated Hermes vice president and portfolio manager Steve Chiavarone. That's at 7 a.m. in New York, 12 p.m. in London. We'll be talking about the enthusiasm in markets globally, cooling a touch, but not much. This is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Ritika Gupta with the Bloomberg First Word News. Joe Biden has chosen California Attorney General Javier Becerra to be his Health and Human Services Secretary. Becerra's job will be to curb the coronavirus pandemic and expand the Affordable Care Act. Becerra is a former congressman but has little experience in the health industry. U.S. Attorney General William Barr is considering whether to step down before President Trump's term ends next month. That's according to the New York Times. The president was angered last week when Barr acknowledged that the Justice Department found no widespread voter fraud in the election. And the Trump administration is set to sanction at least a dozen more Chinese officials over Hong Kong. Bloomberg's learned they're being targeted for their role in the recent disqualification of Hong Kong legislators. Their departure fueled concerns about the city's autonomy from Beijing. And a British official warns that talks over a trade deal with the European Union could collapse today unless there's progress in the next few hours. Prime Minister Boris Johnson is due to speak with European Commission President Ursula von der Leyen this evening. Another British official says that could be make or break moment. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Lisa.
Ritika, thank you so much. Now, we'll talk a lot about the markets. We'll also talk about Brexit and some of the negotiations ongoing in the U.S. on stimulus. The other story to watch out for, U.S.-China trade. That's all coming up next, and this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
surveillance. I'm Francine Lacqua here in London. Lisa Abramovitz in New York. Tom Keane off today. Now, the coronavirus crisis will shrink London's economy by £44 billion, and a full rebound could take until summer 2022. Now, that's a warning today in a new report by GLA Economics Unit at City Hall. With culture, leisure, retail, and hospitality all hard hit by lockdowns and social distancing measures, the report also says 2021 could see a 4.5% drop in the number of jobs in the capital. Well, I'm very pleased to be joined by the Mayor of London, Sadiq Khan, who joins us from the historic Cutty Sark in Greenwich, the world's only surviving T-clipper mayor, and I think built in 1896. And I don't know whether it goes to the kind of deals that you think London and the UK should try and have post-Brexit, but how damaging would a no-deal Brexit be for the City of London? And good morning.
Good morning. It's great to join you again. Look, we as a country, 80% of our economy is in the professional services. We're world leaders in finance, in law, in tech, in creative industries. And unfortunately, the current deal being negotiated by the government fails to address the concerns that these industries have in relation to continuing to do business with our biggest trading partner, the European Union. As it is, it appears even the flimsy deal the government's negotiating may not get over the line. And so we are very concerned about the possibility of a no-deal Brexit. That means not having a deal with our biggest trading partner, or a deal that doesn't reflect our economy. And the irony, of course, is the USA now has a president who's putting the USA back on the world stage, and we, the UK, may become a very lonely country in the future.
So what's the best hope for financial services in this very late stage in Brexit talks?
Well, at the moment, it appears that a number of our sectors that were hoping for a good deal with the EU aren't included. And so even if a deal is reached with the European Union this week, and we hope one is, the problem is for our professional services, finance, legal, tech, creative industries, they will have less favourable access to the single market than they had as members of the EU or during this transition period. And that's why it's really important that the UK government understands the importance of issues like equivalence, financial passporting, the issue of attracting talent to London, and the fact that our ecosystem relies upon people as well as capital and services moving from London to other parts of the European Union.
If we go back into a lockdown that looks more like Tier 3 in London, and if we have a no-deal Brexit, would that be the perfect storm? What would job losses actually look like in that scenario?
Well, London is very similar to other global cities around the world, like New York. We've suffered hugely because of the reduction in footfall caused by the pandemic. Think of industries and sectors that rely upon footfall: retail, hospitality, culture, leisure. And so there's those sectors which normally contribute hugely to our country's coffers, wealth and prosperity, have really struggled. And the concern is the combination of a continuation of this pandemic. Yes, there is great news with the vaccine, but a combination of COVID plus a Brexit with no deal or a poor deal would be really severe for London and our country. As you said, it is a perfect storm, a double whammy, and that's why it's so important that our government wakes up and realises what we're heading towards, rather than sleepwalking into a potentially really deep recession.
What's the right way of doing it? Is it more funds given to London? And how much of these shifts will actually be permanent? How much will the hospitality business suffer longer term?
I think what the government's got to realise is many of these sectors are on life support, and they need to stay on life support because what we can't afford is for these businesses to go bust. It's far, far easier to keep a business viable with financial support from the government than allowing a business to go bust and hoping that people restart businesses. Similarly, it's far easier to keep people in work with financial support from the central government rather than them losing their jobs. Our current estimate is if the government continues down this line, we could see levels of job losses, levels of businesses going bust we've not seen as a country or a city since the 1980s. Nobody wants that, and that's why we're lobbying the government to do much more, in particular to help those sectors like retail, hospitality and culture that have really suffered and normally in good times contribute hugely towards our wealth and prosperity.
when you look at the world-famous theater industry in London, will it ever come back to normal if we have a vaccine and that goes to plan? And if government support stays at these levels, when are you expecting tourism to come back?
Yeah, well, the good news and the light at the end of the tunnel is the vaccine. This week, Londoners and people across our country will start receiving the vaccine, and the government has done the right thing and ordered vaccines from a number of different companies. The combination of the vaccine, but also we're now starting mass testing of those who are asymptomatic, leads us to have hope towards the new year. And that's why it's really important the government gives the support. Most businesses are planning next year not to be as good as 2019, but they want to stay open and viable. We're hoping to see tourists return to our city next summer. It's really important they do so and safely, and that's why it's really important that the government continues to make progress on the vaccine, on mass testing, but also we need to really get on top of the test, trace, isolate system. It's really important if somebody has the virus, particularly if they're asymptomatic, that they know they've got the virus, they can isolate to stop the virus being passed on. We've learned a lot over the last 8-9 months. We've got to use those lessons going forward to make sure we can have a swift recovery, which is really important for our country's well-being.
How much of it is a risk that actually London goes to Tier 3? And this is a tiering system that, you know, all living in the UK will be familiar with. But will you fight to keep it in Tier 2, which is a medium lockdown?
Well, the tiering system isn't perfect across our country. For those of you viewers outside of the UK, we have 3 tiers. Tier 1 is with the least restrictions, and Tier 3 is with the most restrictions. London currently is in Tier 2. We are concerned that there could be an increase in the spread of the virus, a surge, because of a relaxation of the rules during Christmas. And that's why it's really important that anybody who is in London or visits London follows our rules. When you're using public transport, you're in a shop, wear a face mask. When you're in a place where you can't keep your social distance, wear a face mask. You know, it's really important you carry hand sanitizer, wash your hands regularly and thoroughly, follow the rules. That will avoid London going into Tier 3, because Tier 3, because of the additional restrictions, would mean that a lot of the progress we've made with our businesses, like here in the Cuddy Sark, would be undone. That's why it's really important that people follow the rules to avoid us either entering Tier 3 or, even worse, our country potentially entering a third national lockdown.
Sadiq Khan, thank you so much for your time today. Of course, that is the Mayor of London from the world-famous Cuddy Sark.
Stay safe.
Francine, a great interview that really highlights an issue that's being felt globally. In the United States, a similar issue that the longer the pandemic rages, the more people drop out of the workforce. Single best chart of the day, and what sets up the debate over fiscal support in Washington, D.C. is the U.S. labor force participation rate. You could see it absolutely plummet back in April, reaching a low of 60.2%. That was at the height of the pandemic. And now we're seeing that it's clawed back. The reason why I find this chart interesting is it's basically flatlined. It's bouncing around, and it's actually declining with the weaker than expected jobs report now at 61.5%. People are dropping out of the labor force as the pandemic rages. Joining us now to talk about what the U.S. could do about this, whether the current bipartisan fiscal support package does address this gap, this problem in an effective way, is Terry Haynes, Pangea Policy Advisory founder. Terry, I know that you have written a number of fantastic notes talking about how there is an increased chance of us actually passing a fiscal support package. Do you think that what is currently being proposed adequately goes to try to increase the participation rate and stave off long-term scarring in the employment market?
Well, good morning, and I think it intends to, yes, Lisa. I think what markets need to understand, though, is that fundamentally it is this will happen in a two-step. It's kind of a kick the can first, somewhere between $500 billion and $1 trillion for the next 3 months or so, 3 to 4 months until about March. And I think we end up at about $800 billion. And this doesn't get decided this week. It gets decided upon next week. But what you're going to see is a situation where you've got that sort of stimulus coming in the short term, with the idea that the new Congress and the incoming Biden administration gets to decide the direction of travel on further stimulus going forward, with the idea that you've got you will have a different economic look, and you'll also have a situation where the vaccines are starting to come online, and then they can determine how much more stimulus is needed on top of that. So, yeah, I do think it deals with this in the short term.
What's your sense of funding for state and local governments, this big sticking point for Republicans and Democrats for months now?
Well, you're quite right to focus on the state and local assistance, and I want to clarify that it is state and local non-COVID assistance that Republicans are really objecting to. There are two issues here. One is the state and local assistance, which comes in at $160 billion under the bipartisan plan. The McConnell Republican plan does not account for that at all, and Republicans object to non-COVID relief. Similarly, Democrats strongly object to any kind of liability relief or liability moratorium, which is a feature of the McConnell plan. They're going to have to fight each other to a standstill on that this week. What I suspect is both of them end up dropping out. You'll see state and local government COVID-related relief. You'll see at most a little bit of liability reform, but probably not much. And they'll go forward from there and live to fight another day on both of those issues.
Terry, good morning from London. Overall, are we putting too much emphasis on monetary policy? And have we been doing that for 10 years? One of the angles we're trying to explore is actually, does QE do anything for the U.S. economy?
Good morning, Francine. And we have, and you're quite right, we have put too much emphasis on monetary policy for a decade now. And for those of you who wish that we would be moving back towards greater fiscal policy here, I don't see that happening anytime soon, frankly. What you've got is, is a major economic event in the pandemic, among many other things. And that major economic effect is going to be felt for quite some time, and both the central bank and fiscal policymakers are going to be dealing with it for quite some time. But beyond that, what we have had, particularly with the closely divided government in the United States that we have had now for about a decade, whether nominally Democrats have been somewhat on top or Republicans have been, we've had pretty much divided government. Divided government has led to fiscal stability, certainly, over the last decade, but it has not led to much more than that, and there is little to no political incentive to want to take the reins back from the monetary policy folks. The monetary policy, in a political sense, tends to support the political status quo and becomes a self-fulfilling prophecy, I think, that leads to still more monetary policy primacy here. So I think those who are wishing for a return to fiscal policy are wishing in vain.
Thank you so much, Terry Haynes there, Pangaea Policy Advisory founder. Now, coming up, we continue tracking COVID-19 with Joshua Sharfstein. He's Johns Hopkins Bloomberg School of Public Health Vice Dean. We'll talk about the vaccines, we'll talk about the treatments, we'll talk about the lockdowns. This is Bloomberg. explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
We're going to focus on those most vulnerable and those most on the front lines of treating people with COVID with the initial 40 million doses in the next month. And then we're just going to progressively keep adding more and more people. So be thinking in the February-March timeframe that you're going to see more general vaccination. And by the second quarter of next year, we'll have enough vaccine for every American that wants it.
That was the Health and Human Services Secretary, Alex Azar, on the availability of vaccines. Well, joining us now is Joshua Sharfstein. He's Johns Hopkins Bloomberg School of Public Health Vice Dean. Professor Sharfstein, thank you for joining us. Tomorrow in the UK, some people in the front line will start to get their first vaccination. How far away is the US?
Well, assuming all the data checks out as we expect it will, not that far away, probably within a week or so.
How much of a game changer will that be? Do we only really, say that a vaccine is a success once we understand distribution? Like, is the regulatory approval much easier than what we can face afterwards in terms of distribution freezing?
Well, I think the big picture is it is fantastic to get a safe and effective vaccine against a pandemic that is killing now 2,000 or 3,000 Americans every day. And it is the path for this country out of the pandemic, but getting there is going to be challenging, just like you say. We'll have the regulatory review starting this week, and then the vaccines will start, but it's going to get more and more complicated as the goal is to reach the highest risk people as soon as possible, and the better we do that, the quicker the pandemic will end.
Yeah, and Britain already has questions about massive mobilization, A, to get people to take it, to have the right distribution system, but also C, to decide who gets it first. How much more complicated will it be for a country the size of the U.S.?
It'll be complicated because it's being done through the states, and we know the states have very different public health systems, different capabilities, and there'll be a lot of variation, and we'll see some things that work and probably some things that don't work that well. But over time, as more vaccine becomes available, more people will get vaccinated. If we do it well, the pandemic will end sooner.
How difficult will it be to convince some medical workers and the public at large to take the vaccine?
Well, I think that's why this week's meeting at FDA is so important, because it's one thing just to hear there's a vaccine. It's, great to hear it from the company. But what we're going to see is the methodical, thoughtful review of career scientists at the FDA who are doing analyses of the data directly from the data files. They're going to be talking about what it means. We're going to hear from independent advisors who are going to be asking some of the questions that a lot of Americans have. And I'm hopeful that at the end, the explanation will be clear enough that a lot of people are going to understand the value of a vaccine.
We are putting so much effort in talking about the vaccine. Do we need to remember to also talk about the approach to testing and track and trace?
Yes, well, right now we're facing just this enormous surge, a surge upon a surge, as Dr. Fauci said. And, really taking this situation seriously is critical because we are losing many, many lives while we're trying to get to a vaccine. Testing, tracing, all those items of disease control are going to be important, at least very important, for another 6 months. And again, the better we do that, the fewer people will die or get seriously ill.
Dr. Sharfstein, once we have a vaccine, does it mean that social distancing can come to an end, or how long will it take from the last person to have the vaccine from when we truly go back to what it was like in 2019?
I think the key is going to be to keep an eye on community transmission rates. When we start vaccinating just a few healthcare workers, people in nursing homes, the transmission rates are going to be high. We're going to need to keep social distancing. Otherwise, the virus is going to spread like crazy, as it is doing right now in some places. But as that community transmission rate goes down, as the areas go from red to orange to yellow to green, then things are going to start opening up again. Restaurants are going to have indoor dining at greater and greater amounts, and it's going to be safer and safer to do things. I don't think it's going to be like flipping a switch. I think it's going to be gradually the lights are going to come back on, and one day we're going to wake up and realize that we're pretty close to back to where we were.
And we understand, there are a number of questions that we need to answer about this vaccine. How long does immunity last for? And once you get the vaccine, whether you can still transmit the virus, even if you don't become sick yourself. When will we have some of the answers to these questions?
I think over the next, 4 to 6 months, we're going to understand a lot more about how good the vaccine is. It is obviously very good to prevent severe illness and death. And so that's very important. And then we'll see about these other elements of the vaccine as it rolls out. Partly, we'll see how quickly that community transmission rate comes down as more and more people are vaccinated.
Thank you so much, Joshua Sharfstein there of Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now, global stocks are actually retreating from an all-time high. They're not moving a whole lot, but they're still moving by 0.1% lower in Europe. The pound weakening the most in 3 months on concern that Brexit talks could actually collapse. Now, this is the state of play for Brexit talks. We did hear from a British official warning that talks over a future trade deal with the EU could fail today unless negotiators make progress in the next few hours. We know that the Prime Minister, Boris Johnson, is due to speak to the European Commission President later this evening. That conversation could be a make or break moment for Brexit. Coming up, more Bloomberg surveillance.
Somebody, any head of state in the world, how hard is it for you to get anybody on the phone? I assume not too hard.
I would say it's not too hard, but sometimes it takes a week.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into this SPAC thing a little bit before it became such a hot method of going public.
We are in a very serious reach
for yield environment.
We still have a lot of bad news to get through over the next quarter or so.
The tea leaves have never been harder to read.
These payroll reports are getting overshadowed by positive news.
Certainly some support is going to be needed going forward.
What monetary policy can do, most importantly, is to support fiscal policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Tom Keene away today. He'll be back tomorrow. Friday, record highs across the board. The Nasdaq, the Russell, the S&P 500. This morning, down 11 on the S&P 500. Lisa, the story pretty clear. More infections, more restrictions, more pressure down on D.C. to act, and more support for that bipartisan bill.
Yeah, but it also shows the divergence between the underlying economy. Bad news being good news once again, with this idea that there is that pressure for that $908 billion stimulus bill back in Washington, D.C. When are fundamentals going to matter again, John? When do we actually have to see something positive in order to respond to it?
Well, it's the fundamentals of 2021. 3Q, 4Q. That's what people are reflected on right now. The imagined fundamentals of 3Q, 4Q, 2021 and pricing in that story, Lisa. If you're asking the question if the fundamentals in the here and now are going to matter anytime soon, the data for this month, then I think, yes, they matter to the policy conversation. We saw that on Friday. Did they matter to valuations? Not right now, no.
Yeah, and meanwhile, we do have other issues. I know that you love talking about Brexit, so I'm sure we will touch on it because those talks are not going that well. We've got that. We've got trade concerns. We also have some potential harder line tactics by Mike Pompeo. So all of these things sort of factoring in, but really being brushed over by an incredible amount of fiscal support. Not only is it in the U.S., but also over in the European Union. The deadline for the $2.2 trillion stimulus and budget deal today, there are some nations pushing back, particularly the Eastern European bloc, the Eurosceptics. Still, the broad expectation is they will get something done, albeit with a bit of negotiation. In the U.S. side, details of that $908 billion bipartisan U.S. relief bill are expected. The key question to me, John, and we keep talking about this, is aid to state and local governments. Are we going to get that? We see that right now, stocks pricing in, we will get something and we will get it soon. Also today, the cutoff date to register to vote in Georgia, those Senate runoffs happening. That's January 5th. Really important to see whether the composition of the Senate will shift. The idea here being if there is a Democrat majority, you could increase your expectations for an even bigger fiscal support package or perhaps stimulus next year, John.
Lisa, how point 2 plays into point 3 of the stories you've just laid out, I think is really important. $160 billion of state aid in that bipartisan bill. Do we all start to get some support around that story, or are we still playing politics? The idea that these are poorly managed states. Lisa, I struggle with this idea that they don't want to help what they call poorly managed states, but they're happy to help the airlines and give aid to what many investors consider to be poorly managed airlines for the last 5 years.
Yeah, well, that's a good point, and I'm not going to particularly weigh in on it because that will leave that to the politicians to sort of hedge and haw and hem. I do think there is a point here. How do you parse out what is the pandemic-driven weakness versus weakness that was already there? And the fact that they're trying to do that seems like a no-win game, because how can you even get those aspects out? If you want to help, try to help, John.
Here's the price action this Monday morning. Futures down a little bit. We're off 12 on the S&P 500, negative about 1/3 of 1%. We pull back on the S&P from all-time highs. Euro dollar still north of 121, but this morning is a dollar strength story. We'll talk about some of the sterling weakness in about 27 minutes. I promise you, Brexit-free zone for at least 25 minutes, okay? In the bond market, yields come in 2 basis points to 0.9443%. Yields just out to that new post-pandemic shock high of Friday, Lisa, off the back of a downside surprise on a payrolls report. The idea being that's the stimulant to make the stimulus happen. The Fed meeting next week. Let's just jump past the ECB just for now.
Wait.
I think the Fed meeting, Lisa, for this bond market, very much in play for the people that don't believe the Fed will allow yields to go through 1% and go much higher at the long end.
Yeah, it's actually one of the most compelling questions to me of the next 2 weeks is how much could the long end sell off if the Fed does not extend the duration of their bond purchases? By the way, John, brilliant. Stimulate the conversations for stimulus. Wow, I'm going to have to use that.
Do you like that? You can have that.
Can I?
I will source that out. Yeah, you can lease that. I don't know. We'll come up with a fee or something.
I'll give you a bottle of wine for royalties.
I'll take it when I'm back in New York. Steve Chevron joins us now, Federated Hermes portfolio manager. Steve, 7:05 Eastern time has become like therapy for investors and our audience after rattling through all the negative news. And I think that's been a job of the investor, for the market participants to almost receive that therapy. All this stuff going on around us, which is absolutely dreadful, and thinking about a better 2021. Have you had the therapy, Steve?
Yeah, I think I do. I mean, I think we've been pretty calm through the last few months. Look, I mean, what you've seen in terms of a recovery is shocking. I mean, in terms of the number of people that have gone back to work, in terms of the rebound in retail sales, manufacturing, housing, I mean, you really do have in a lot of sectors of the economy a V-shaped recovery with a lot of stimulus coming, not just the fiscal stimulus, not just probably a little bit more from the Fed in terms of extending duration and things of that nature, but the vaccine itself represents an enormous stimulus over the course of next year as we gradually get back to normal. And I think that's what the market is looking through. Now, that doesn't mean we don't need support for certain parts of the economy that are really in for it right now with these increased restrictions. But that's really about doing the right thing for sectors of the economy. The market as a whole, I think, is in a much healthier place than certain sectors are.
Steve, I get this argument that we're pricing in 2021 and that we're looking toward a period past the pandemic. Yet, if we've already priced that in, what more can we price in to drive the market higher?
Well, Lisa, I don't think we are just pricing in 2021. I think it's a longer-term runway of growth. Remember, outside of 1980, 1981, there are no real examples of double-dip recessions since the Great Depression. When you're looking at recoveries and expansions, these last 3, 4, 5, 6 years, sometimes as many as 10 years. And we just had a recession. We've cleared the deck. We're in early cycles. So yes, the market's immediate focus is on the recovery in 2021. But in reality, you have to start pricing in the idea that we've got a number of years of first recovery, then expansion, and markets are going to respond well to that.
Lisa, Tom and I have been going through the same story, Steve, over the last several weeks, and I've sat here frustrated, sometimes bored, at the outlook because it's very samey. And I'm wondering whether the groupthink has actually become group action. Are you worried about actual crowding, or as far as you're concerned, the money hasn't actually been put to work, this is just talk still?
Look, I think this is what the scary part about the early part of a cycle, because you'll see big percentage moves and think that you've missed the whole thing. But let's put it in a perspective, right? Small caps have outperformed large by, let's call it, 10 to 15% since September. But they've underperformed for the last 5 years. They were flat for the last 2 years. Even if you look at value versus growth, the 10 to 15% outperformance you've seen there, value underperformed by 50% in the first half of this year. And so we think it's really those uncomfortable trades around value, around small caps, around international, which has started to show signs of life, and around dividend payers that are really going to continue over the course of the next year. We think that they're still relatively early in their days. And we think, again, while the market has priced in a better 21, we don't think that the market has priced in, a longer-term growth trajectory.
Steve, this idea of being early is a word we hear so many times, and this idea of it being uncomfortable and it being uncomfortable to get in the early part of a bull market. And I think April was uncomfortable. Right now, can you call it early when we've got a record high in the Russell, a record high in the S&P 500, and a record high in the NASDAQ? I mean, just looking at recoveries, you're a student of market history, much more than I am, Steve. You know, when we start an early stage recovery, do we start at record highs?
We don't get there this quickly, but you can. So, for example, if you think about the decline in 1987, you were back to all-time highs within about a year of that 35% decline. And I can assure you, you didn't want to sell in 1998 because you still had a market bull run until 2000 almost. Yes, this can happen. Even if you look back at the last recession that we went through, right, you got back to the all-time high in 2013. Again, it would have been very easy to say, well, okay, we're back to the all-time high. We're long in the two. You get another 6 years after that. So, no, I don't think it means that we're late just because we're at all-time highs. I think it's just the nature of this recovery and the amount of stimulus that we got that allowed us to get back to the highs so quickly.
I was reading Morgan Stanley's look ahead yesterday. Andrew Sheets came out and he said that one reason for their bullish outlook is that they expect fiscal and monetary policy to work together, yet they still expect the 10-year yield to get up to 1.45% by year end. How high can that yield go before it derails the equity rally?
Look, I think it's a function of what the economic context is, right? So if you're still in an economic malaise or you have slowing economic data and you get a surge in yields because there's expectations that the Fed won't be as dovish, then obviously that's something that's bad. If, on the other hand, we're getting higher yields on the back of stronger and stronger economic data, more and more people going back to work, more normal levels of activity, I think that's fine. Right now, both the yield and the spreads are so low and so tight that it suggests that equity multiples could be in the mid to high 20s. We don't need them to stay that high. So there is some room, I think, within a healthy economic recovery for yields to rise and the market to be okay with that.
Steve, great to catch up. Is it too early to say Happy Christmas, just in case we don't see each other? Enjoy the holidays.
This year, take the opportunity, my friend. Merry Christmas.
Enjoy the holidays. Merry Christmas to you,
Thank you,
Steve
sir.
Cheveron of Federated Hermes. Thank you, sir. Promised I wouldn't do this. I'm going to break that promise, forgive me. Von der Leyen
Knew you
of
were
the
gonna do
EU will be holding a phone call at 5 p.m. with Prime Minister Boris Johnson, 5 p.m. local time. Lisa, I feel like I'm obliged. I have to.
You have to.
I don't want to. I don't want to cover Brexit for the next 20 minutes.
Okay,
How's that?
I understand
Unfortunately,
that-
right now, I have to.
You don't want to, and yet it really is a story today. And it will continue to be a story over the next year, 2 years, but it's moving markets again.
It's a story because they're talking, and it's a story in the market because The Sun, a British tabloid, reported this morning that the Prime Minister was ready to walk away. These briefings have an audience. These leaked headlines, these stories have an audience, and the audience isn't necessarily the British public or the European public. It's the other side in the negotiations. This is part of the negotiations.
John Farrow is
Us
ready
reporting on these headlines.
for 2020 to be over.
I think I'm ready for the Brexit negotiations to be over. Everyone's ready for 2020 to be over. Sterling 132.76 is started the day with a 134 handle on cable. Coming up a little bit later, Jason Draho of UBS. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. One Republican senator predicts that President Trump will get on board with a bipartisan $908 billion package for coronavirus relief. Senator Bill Cassidy told Fox News that Senate Majority Leader Mitch McConnell will back it too. Cassidy is a member of the group that's pushing the measure. President Trump's lawyer, Rudy Giuliani, has tested positive for the coronavirus. According to reports, he's been hospitalized in Washington. Giuliani's son says he's getting great care and feeling well. Giuliani has been leading the efforts to overturn the results of the election. In China, exports jumped in November by the most since early 2018. That's pushed its trade surplus to a monthly record high, and it underlined how global demand for pandemic-related goods is helping the Chinese economy rebound. And it's another blow to New York City's stature as the home of the U.S. financial industry. Goldman Sachs is considering plans to move its asset management unit to South Florida. Goldman's success in operating remotely during the pandemic has persuaded the firm's leaders that they can move jobs out of New York to save money. As early as this week, Facebook will be hit by federal and state antitrust lawsuits. Bloomberg has learned they'll accuse the social network of abusing its dominance and thwarting competition. The lawsuits will be filed by the Republican-led FTC and by a group of state attorneys general led by New York's Letitia James, who is a Democrat. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
mkokoteni ya stima ningeipata naweza sikia vizuri sana kwa sababu inatumia nguvu sana.
The advantage of the electric handcut over the manual conventional handcut is that one, it increases the productivity level of the users. Two, it is eco-friendly in that it does not pollute the environment. Three, it increases the income level for their users in terms of loading capacity and also in terms of productivity.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Now, neither have said, oh, we'll sign your bill. That's fair. We have final language. Our final language, Chris, will probably come out earlier this week. And so then people can look at it and we can modify it as needed. But the indications I get, the pain of the American people is driving this, and I'm optimistic that both those leaders will come on board.
That optimism is building. That was Louisiana Senator Bill Cassidy speaking on Fox News Sunday, live from New York and London this morning. Good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene is away today. Let me touch on a price action just briefly this Monday morning. Record highs at the close on Friday. Another week of gains, 2 weeks of gains on the S&P. We pull back. We're down 12 points, off by a mild 1/3 of 1%. Some talk this morning, some reporting from us actually, that maybe the United States is lining up to sanction more Chinese officials. We'll try and touch on that a little bit later. In the FX market, euro dollar softer, weaker, euro 121.12 going into the ECB meeting this Thursday. And in the bond market, yields coming in after a significant move last week. Yields up and away. 0.94% is your 10-year yield this morning. We come in about 2 basis points or so. Let's pick up where Senator Bill Cassidy left things, shall we, on the stimulus discussions, the aid discussions down in Washington. Kevin Cirilli, Bloomberg chief Washington correspondent, joins us now. Kevin, how important is it that we see more and more signs, more Republican senators lining up behind a bipartisan effort?
It's massively important. And in fact, they run the ideological spectrum, and that's really what I've been struck by. And candidly, it's why so many here in Washington, D.C., Jonathan, feel that there is optimism to get behind a fiscal stimulus deal in the lame duck. People like Senator Cassidy, as well as Senator Richard Shelby, a deeply conservative member from Alabama, to the likes of more moderate, centrist types of Republicans like Susan Collins and Rob Portman, all expressing their interest in this, and even Secretary Mnuchin, as well as President Trump, giving some optimistic messaging that has come out of the White House. It's been a remarkable turn of events, a remarkable thawing of sorts between Speaker Pelosi, who's eyeing down a shrinking House majority in the incoming Congress, and Senate Majority Leader Mitch McConnell, who has really held strong in terms of the $500 billion number, and as a result was able to get Democrats to go below the $1 trillion mark.
So, Kevin, within this bill, as you know, is $160 billion of state and local aid. I think we'll get more details a little bit later today on what's actually inside this. But on the 160, I've heard, as you have, and many others have as well, from the administration that they are uncomfortable helping what they perceive to be poorly managed states. Can you maintain that position given what's playing out across that country right now, this country in the United States, over the last several weeks, Kevin?
The Republicans say yes, provided that the price tag stays below or around $1 trillion. And even digging deeper into that, once the text of the bill is released, I'll be looking carefully to see what lending programs and grant programs and loaning programs there are coupled into this $908 billion bill. Many of the Republicans that I speak with are much more interested in trying to make sure that Main Street and businesses, and even beyond Main Street, sectors that have been heavily hurt as a result of this, I'm thinking about tourism, hospitality, as well as others, that they get some type of lifeline as we head into what hopefully will be the final months of this global pandemic.
Kevin, a lot of people are viewing this proposal as a stopgap measure, a sort of intermediate plan, and there will be another one passed next year. And yet it seems like, given the Republican pushback, if there isn't a Democrat majority in Senate, it seems like it may be an uphill battle. Am I reading too much into that, or is that accurate?
No, it's incredibly accurate. Look, make no mistake, the United States is in a position right now to spend and to spend big. And the first piece of legislation in the lame duck at about $1 trillion is going to be that lifeline to get the economy injected with some more economic stimulus. But the second one, and this is where it gets interesting, is that you could see longer term investments and stimulus funding as it relates to infrastructure, digital infrastructure, manufacturing, as well as a host of other lifelines, that yes, the political argument will be made that it is as a result to get the economy moving from COVID-19, but it's also an opportunity for the country to really look into some of their longer term investment strategies and infrastructure strategies over the course of at least the next decade.
Yes, but we've been talking about infrastructure week, infrastructure year. There was bipartisan support. Nothing got done. Here we are. We've got pushback from a bill to provide a lifeline. I'm just wondering if the Georgia runoff comes back, as many people expect, and Republicans win, and they keep the majority in Senate, does it seem likely that there will be an additional bill, or is that more uncertain than perhaps people are making it out to sound?
It's much more uncertain than folks are making it out to sound. However, I think based upon my reporting, if they are able to tie this to longer term infrastructure, digital infrastructure through the prism of national security spending, they might have a better shot. I'm talking about the incoming Biden administration. They might have a better shot of luring some of those moderate Republicans like Senator Portman and Susan Collins in order to get them on board. Look, I think that without question, it's going to be another fight, but this is going to be, based upon the public comments of the president-elect, this is going to be the first political battle that he seeks once he assumes office on the domestic front.
Kevin, I want to finish on the current president who actually went down to Georgia on Saturday and campaigned. Many people are asking whether it actually helps. He keeps talking about an election which he thinks, and is continuing to pursue this through the courts, he thinks legally should be overturned. Kevin, do you think that helps get Republicans to show up, to turn out for the Georgia runoffs?
Well, there are many Republicans, based upon exit polls as well as data from the past two elections, who were much more supportive of President Trump than they were of the Republican Party. But the unknown variable is whether or not his presence draws out progressives and the progressive base as an opposite effect in what he would rather see. And we'll find out in January 5th.
And we wish the former New York City Mayor, Rudy Giuliani, the best, who has tested positive for COVID-19. COVID, thank you, sir. Kevin, thank you, sir, rather. It's been a long year. Bloomberg Chief Washington correspondent. You know why I got distracted, don't you? Another Brexit headline. The EU seeing Wednesday as the cutoff day for a Brexit deal, officials say.
Honestly.
Lisa, headlines are imagined, aren't they? It's just something we imagine and we all agree to, and then they move again. They only mean anything if there's actually going to be follow-through. Okay. Could be Wednesday, could be Thursday. I've got no idea what the deadline is.
John, you're getting really existential on this Brexit thing. Headlines, we come up with them. They come out. I mean, basically,
but
people...
we do.
I mean, I understand that. I do think, though, there is something fundamental here, which is we do have the December 31st deadline, and Boris Johnson has to get a certain amount of political support. The EU is digging in its heels. Look, this has been going on for a long time. It still is a real issue, especially because there is a deadline, John.
Is the deadline Wednesday or December 31st?
Okay, I get your point. The idea that they keep drawing lines in the sand, right? And December 31st is the harder line in the sand.
Is it? I don't know. I've seen
What's
so many of these deadlines over the last 4.5 years.
Look, you're fair to be skeptical.
What's a deadline?
Right.
What's a deadline?
Really, existential Mondays with John Farrow.
Imaginary construct. That's all a deadline is.
Imaginary construct.
From London and New York this morning. Good morning. Alongside Lisa Abramovich, I'm Jonathan Farrow. Maybe there's a part of me that would like to see Tom come back. I don't know. Maybe I miss him. Maybe that's what the mood's about.
I'm sure.
Who knows? Cable 132, the pound $1.32.79. We're down a little more than 1%. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Monday morning, live from London and New York. Good morning to you all. Let's get straight to the price action of the morning, shall we? This Monday, we set up as follows, with equity futures coming in 0.4% on the S&P 500. Record high on the S&P, record high on the Nasdaq, record high on the Russell. Just a small move lower, down 0.2% on the small caps. The Nasdaq on quite a winning streak on a daily basis. I think about 8 days on the Nasdaq 100, moving higher. We come back in about 0.1% there. S&P 500 futures down 0.4%. That's the equity market. Switch up the board and get to the bond market. You know all about treasuries through last week. Yields up and away. The idea, we get a downside surprise on payrolls. That's the nudge down in D.C. to get a deal done in Washington. Yields up. This morning, yields lower by 2 basis points on a 10-year. The spread between the United States and Germany, how wide can it get if the German 10-year is going to be pulled, pinned to the floor? We know that it can go well north of 200 basis points. We saw that at the back end of 2018. Is that what you're looking for again? We'll talk about that in just a moment. In Italy, how much tighter, not wider to Germany can it get, but how much tighter to Germany can it get? The Portuguese 10-year last week, 0. That was your yield. This morning on an Italian 10-year, 60 basis points, just off an all-time low from earlier in the session. A record low on the Italian 10-year, and people see it with scope to go even tighter to Germany, given what's happening on the periphery elsewhere. That's the bond market. Let's finish on foreign exchange. Surprise, surprise. Here it is. Yeah. Sterling, intraday, cable, gapping lower off the back of a tabloid report here in the UK from the Sun newspaper, reporting that talks could collapse and the Prime Minister could walk away. Within hours, the pound goes from 134 to start the session down to around about 132.80, just a little bounce off the low there. Lisa, it really is that exciting. It's just a continuation of what we've been talking about for 4 years, except this time I'm told it matters.
All right, let's talk about the construct of a deadline in the scheme of human history, because that's where we're at this morning. Existential Mondays. We're going to get a little bit less existential. Bloomberg's Maria Tadeo joins us from Brussels. The European Union is said to see Wednesday as the cutoff for a deadline, going to John Farrow's point about all of these artificial deadlines that keep coming up to try to goad all of the players to some sort of agreement. What is the reality right now of Brexit negotiations?
Well, Lisa, there's a number of elements and issues that you have to take in mind here. First of all, the talks are still ongoing, so the situation is actually very fluid. Then you have the optics. You know, this needs to be seen as difficult. Everyone here needs to be fighting or be perceived as seen as fighting hard for their country. And then, of course, you have the politics. Ultimately, this will be a political decision, not a technical one. But we understand that today there will be a phone call at 5 p.m. Brussels time, 4 p.m. UK, between the head of the European Commission, Ursula von der Leyen, and the Prime Minister, and that could set the tone for the talks going forward. We understand also from the European perspective is that they do not believe the Prime Minister is going to walk out or is close to walking out. In fact, they believe the talks will continue until Wednesday. After that, there will be a summit here in Brussels in person. Angela Merkel, Emmanuel Macron, all of them will be in Brussels, and then that decision could get made. The one thing that I will really stress is that this fundamentally is a political decision. The Europeans have to make a decision that they can't trust the UK going forward, and the Prime Minister needs to make a political calculus that whatever deal he gets will pass the Brexit test. This is about taking back control and sovereignty.
Maria, what is the actual deadline?
Look, the actual deadline, I would say, would be Friday this week. We know that for technical talks, that would probably be Wednesday. There is simply too much to be done for a breakthrough to happen in the next 48 hours. That's basically what we hear from European diplomats. But it really is that European summit happening here in Brussels on Thursday, ending Friday, potentially going into Saturday too. That is seen very much as the deadline. Now, on a legal basis, there needs to be time for both parliaments to ratify this. But the understanding is that once you do get to a political agreement, both parliaments will vote it through. You don't put something to a vote if you're not sure you're going to get it through.
Europe's done it before. I mean, they could do it again. Maria, great to catch up, as always. Bloomberg's Maria Tadeo over in Brussels. Cable, 132.71, a much weaker pound. Sterling is where the underperformance is this morning. Lisa, the world's moved on. Don't you get a feeling for global markets, for investors? I've said this repeatedly over the last few years. For about a month or so, it was the global story for markets for about a single month after the vote itself. Then it was a story for Europe for the next few months. Since then, it's been a story for the UK.
Yeah,
and the world increasingly has moved on.
Well, and partly this is because the UK is becoming increasingly isolated from other areas. I mean, you talk about the financial services sector and other areas. But I also think, John, honestly, in the scheme of the pandemic, Brexit just doesn't feel that
Absolutely.
big.
It just does not feature in the 2021 outlooks that I've read, that you've read, that any of us have read, really, for global market participants. Jason Draho is one of them, UBS Global Wealth Management, head of America's Tactical Asset Allocation. Jason, I guess the question for many of us over the last few weeks or so is, what would it take to really dent risk appetite, given how buoyant it's been over the last month?
The one thing that would really, I think, change sentiment is, news on the vaccines not being perhaps as effective, or being, at this point, being sort of rolled out and leading to either herd immunity or some sort of kind of clear abatement of the pandemic by the middle of next year. That's a really consensus view. I think that's what everyone is sort of kind of bulled up on for next year. If we find out in the next month or two, for some reason, that's not going to happen on the timeline that people expected, I think that would be the one thing that would really disappoint markets. On the policy front, I think we've kind of learned that politicians can always move the deadline, as we've talked about before. But I think the pandemic news, I think, would be the one that would be sort of most disappointing to the markets at this point in time.
Jason, as we know also from experience over the years, nothing changes the narrative quicker than price. In the bond market last week, there was a breakout in 10-year Treasury yields, and I think increasingly we've been asking that question. What kind of level does it start to kick in at? 110, 120, 130, 40, 50, where it really starts to take a punch into people's risk appetite going forward. Do you have levels in mind, Jason?
So I think getting up to 110, 120, that's perfectly fine. It's always the case for the bond markets and for yields in particular. It's not the level, but the pace that matters the most. So if we suddenly get news where, that might be good news, but the 10-year goes from 94 basis points to 1.3, 1.4% in a matter of a few weeks, I think that's going to take some time for equity markets to digest. You'll probably see some sort of pullback there. That's only likely to happen if for some reason the Fed suddenly sounds less dovish. If they give something that would be tantamount to like a taper tantrum or a rate tantrum in this case, which there's no real indications of that. So if the rate rise is more gradual, reflecting improving fundamentals, I think you can see the markets kind of absorbing that reasonably well. And it's unlikely you're going to see the 10-year get too much above those kind of levels, because what the Fed is going to be concerned with is our financial conditions getting tighter, and right now they're incredibly loose. If that looks like it's leading to tighter conditions, then you probably see some language from the Fed that leans a little more towards being dovish, kind of pushing back against that move in the market.
So perhaps U.S. equities can be resilient to higher rates up to a point, but it raises a question of whether they can outperform. And Goldman Sachs put out a note where they said, in an environment where Treasury yields are rising, they expect international stocks to do better, emerging markets, et cetera, as the tech stocks and other shares that have done well in the interest rate environment that we've had will not necessarily do as well as yields go higher. Do you buy that argument?
Well, I think you have to always look at what's kind of driving that scenario. And if we have a situation where next year rates are rising because of better growth, I think that is a situation where international markets, whether it's emerging markets, even Europe, could do better than the U.S. And the parallel I draw is to the 2016-2017 time period. 2017, if we look back in the good old days, the S&P had pretty much a straight line higher throughout the whole year, very low volatility. Total return was 22%. But emerging markets were up 35% that year. It was a year in which the global economy was kind of growing above trend. It's accelerating. It was a very conducive environment for risk assets to do well, equities to do well. It was also a year when the dollar was down about 9%. And we could be setting up for something similar, at least in the next 6 months time frame.
So, Jason, perhaps you've heard that John has a rather existential tone today, and it comes after he read all of the various look-ahead outlooks from the various Wall Street houses. And I got to say, he's not wrong about there being groupthink. And actually, JP Morgan came out and said that there is the strongest consensus trade in markets since late 2017, early 2018, based on their calculations. Does that worry you?
It would worry me if we had this bullishness combined with complacency. And I don't think we have the complacency just yet. I mean, a very simple measure looking at that is, where's the VIX? It's still a little bit above 20. Yeah. If you look at strategies that will lever up, they're not anywhere kind of near where they were in early 2018. But again, we had almost like a market melt up in January, and then we had the Volmageddon situation. So I think people are definitely bullish. And we look at the landscape to say, well, what is the environment next year? A global environment of accelerating growth above trend. And that kind of quadrant of your matrix, that's historically the best environment for equities. So the fundamentals sort of justify, I think, a pretty bullish outlook. And you think about what could turn us bearish, well, the pandemic comments I made earlier. I'd be really concerned if you started to talk about sort of euphoria. I think we're not there yet. I mean, there's a possibility. I think there's a chance that markets could be melting up over the next couple of months as we get vaccine rollout, we get another fiscal deal, we get the Georgia elections out of the way, you kind of get that political risk is taken off the table. And so we could get definitely kind of a market melt up into early next year. That, to me, would be a temporary risk. But other than that, I think it's really, I think that the positioning and the overall sentiment is bullish, but sort of not complacent. To me, that's the key.
Well, euphoria is always so much easier to identify after the fact. When you're in the moment, Jason, there's always these great stories to justify, to rationalize why we are where we are. Back in early 2018, it was that huge short vol trade, that concentrated risk, Jason, that really just blew things up. And I remember, I think it was just one big payrolls report that just undid things. People started to think about a different regime, breaking out into a different regime. Into 2021, Jason, anything like that in your mind, just the change of the regime and what could spark it?
Well, that's an interesting parallel that you drew to 2018 because it was a payrolls number that exceeded expectations. It was the average hourly number that went better than expected. It suddenly got people worried about inflation and the Fed tightening. So that was a case of good news being bad news for the markets. Right now, we saw on Friday, the jobs number was disappointing, and it was sort of bad news being good news. We're in that kind of climate right now because people expect more fiscal policy. So I think as long as we kind of in that environment, then people sort of look through any sort of near-term weakness. What could change that? I think it comes down to signs of the recovery not sort of being, on track, the pandemic, kind of abating, not being on track. And there could always be something, again, another factor that we're not really kind of, thinking of. I mean, no one this time next year was forecasting, a pandemic, even though there was early signs of, something's kind of going on in China. So it could be something along those lines. It probably won't be 2018 because position isn't there to that extent. But obviously we have to be kind of, clear that there's something going to happen. The key thing I have is over 6 to 12 months, the fundamental outlook looks like it's going to improve. So if we get sort of something that pulls back markets, I think you have the mindset where that's a buying opportunity. So it has to be really something deteriorate in the fundamental environment to get people really to kind of de-risk or for markets to pull off significantly.
Jason, great to catch up, sir. Really good to hear from you. Come back soon. Jason Draher there of UBS Global Wealth Management. Futures lower today, off by 0.4% on the S&P 500. Isn't that the story, Lisa? The appetite to buy the dip is so strong. There's hardly been any dips over the last month.
Isn't that the truth? That's the story of 2020.
Coming up on this program, Dr. Mercedes Carnathan, Northwestern University Department of Preventative Medicine, the Vice Chair, joining us very shortly right here on Bloomberg.
With the First Word News, I'm Ritika Gupta. Joe Biden has chosen California Attorney General Javier Becerra to be his Health and Human Services Secretary. Becerra's job will be to curb the coronavirus pandemic and expand the Affordable Care Act. Becerra is a former congressman but has little experience in the health industry. U.S. Attorney General William Barr is considering whether to step down before President Trump's term ends next month. That's according to the New York Times. The president was angered last week when Barr acknowledged that the Justice Department found no widespread voter fraud in the election. And Apple is looking to outperform Intel's fastest chips. It's planning a series of new Mac processors for introduction as early as next year. Apple engineers are working on several successors to the M1 custom chip. Now, that was Apple's first main processor that debuted last month. If they live up to expectations, they'll outpace the performance of machines running Intel chips. And Universal Music is buying Bob Dylan's entire song catalog in what's described as a blockbuster deal. It's a collection that spans 6 decades and includes such as Blowin' in the Wind and The Times They Are A-Changin'. Universal's not saying how much it's paying. People familiar with the term say Dylan's songs are worth more than $200 million. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Get out of this very, very quickly. We expect to get close to herd immunity sometime during 2021 for the major economies. That's going to change the mood in the economy. So we expect a pretty strong rebound.
We all hope for one. That was Axel Weber, the UBS chairman, speaking to Bloomberg earlier this morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene is away. He'll be back with us tomorrow, live from New York and London on Bloomberg TV and radio. Let's get the price action this Monday morning. Futures do pull back from all-time highs. We're down 15 on the S&P 500, off by about 0.4%. A more assertive, stronger US dollar through G10. The euro slightly weaker, down to 121.10. In the bond market, 0.9361 to 0.9377, whatever you want to pick. Yields about 0.94%. We come in 3 basis points on a 10-year. Next stop for this bond market, the next big stop, Lisa Abramowitz, has got to be that ECB meeting this Thursday. The ECB has communicated pretty clearly. We want you to focus on the duration that will be in this market, buying bonds. Do you think the size of the package is what investors will still be focused on?
Well, the ECB certainly wants to divert attention. At this point, though, what more can they buy? I mean, right, aren't they running out of space? And if they indicate that they are going to emphasize duration, will people start to get nervous that they feel like they're running out of room to buy more debt? John?
Italian 10-year yield, all-time lows earlier in the session. That's the story of the bond market. Let's get to this brutal pandemic sweeping across the United States of America. Joining us now, I'm pleased to say, is Mercedes Carnathan, Northwestern University Department of Preventative Medicine Vice Chair. Mercedes, Professor, fantastic to get you back on the program with us. Thank you for joining us. Secretary Azar over the weekend saying that perhaps by Q2, all Americans that would like the vaccine would have access to the vaccine. Is this the timeline that you're putting into your models, you're thinking about increasingly as well?
You know, that is what I have heard as well, that hopefully by April, availability of the vaccine will be such and production of the vaccine will be such that everybody who wants it will start to be introduced to the opportunity to get it. Because you have to keep in mind, it's 2 factors. It's how many doses of the vaccine do we have available, and how can we get it?
I'm placing an order, ladies and gentlemen, to buy British pound for 132.645. 132.645. Okay, order placed to buy this price. Let's see. Oh, it's going too far. Not much point to hold this order. Yep, let's wait for other time. Order cancel.
Can get this rolled out, but for right now, our behaviors can't change.
So, Mercedes, this is the question, right? I mean, how should it be rolled out in order to prevent the deaths that are inevitable, that are climbing, that we're seeing record hospitalizations currently? How do we best distribute in order to prevent the rampant spread as many people are predicting?
You know, what I'd like to see, I've heard some discussion about essential workers who are delivery drivers, who are front-facing people in stores being eligible early on for the vaccine. And that would solve two problems. For a large proportion of those workers, those individuals, their income isn't as high. They aren't able to socially isolate themselves. They don't have vast homes to be able to spread out. And those populations are often at highest risk for the most severe outcomes and hospitalizations. So it would be ideal to see that population in the next round.
The good news, Professor, is we've had months to think about this, how to roll it out. What I still don't know, and maybe you can help me, is how long does this last before we have to go back again and get another shot, get another vaccination? So as I understand it with Pfizer, you get one shot, 21 days later or so, you get another shot. What is your immunity like after that? How long are the antibodies there for? Professor, do we know the answers to that?
If I had the answer to that, I would be making a lot of money. I think right now we still are in the position where we know what we know and we don't know what we don't know. And so I am not sure about that answer, how long one will remain immune. I think, that information stands to come out at the time when they actually publish their trial results. Right now they're getting emergency use authorization. We haven't seen the final reports, and hopefully there'll be some hints in there.
Are you a little worried about the duration that it might be? Do you have a range in mind, Professor? I apologise for putting you on the spot, because there is a belief at the moment, and we all share this hope, that by the middle of next year, in places across the world, around the planet, we've got society to a position where we can roll back many of these restrictions. But I think a big worry for people would be if we had to go and do this all over again, quarter after quarter, to make sure this lasts. That would be a much bigger effort. Do you have a time range in mind?
That would be a much bigger effort. I think what I remain hopeful is that this particular vaccine, which I hear is a unique approach to vaccination and how it's targeting the virus, that it will not be like the flu vaccine that the flu virus mutates quickly. The coronavirus doesn't mutate quite as well, I think, as the flu virus. However, and the way that these vaccines have been developed, there's something that is targeting something a little more central to the virus, so that ideally this will last longer than 1 year. However, I haven't seen the final reports yet.
Mercedes, I just want to wrap up with where we are in the pandemic right now. We are seeing record numbers of cases in the United States. We're seeing hospitalizations. We're seeing ICU units at capacity. How concerned are you about the next month in terms of the worst aspect of this pandemic?
The worst aspect of this is, you can always build field hospitals, but how are you going to staff them? As we are filling up the hospitals and ICUs and using up the life-saving equipment, we need people to run that equipment. And that's where we're actually running short right now. So that concerns me a great deal. Our healthcare providers are burnt out. They are exhausted. This is emotionally and physically very draining. So it's very concerning. And the best thing that we can do is to adhere to mask wearing and social distancing so that we can try to tamp this down.
Professor, we appreciate your hard work and your contribution to this program. Thank you. Mercedes Carnathan of Northwestern University. Lisa, the hard work is not over yet.
Yeah, and people are sick of social distancing. They're sick of it, and you see it. And the question I have as I walk down the street, how do you deal with restaurants that are going to close down because people cannot go inside? It's getting cold. They're not going to be eating out. And then all of a sudden, there are more job losses. It's going to be a tough winter, John, and you see it on the street.
Officials struggling with compliance. Did you see the pictures out of London over the weekend? Storming Harrods, storming Oxford Street. That's the story at the moment. People just getting out there and trying to get on with life. And maybe in the views of officials and experts, that's premature.
But the interesting thing to me, John, is that right now, markets completely shrugging all of it off. And I remember earlier this year when people would look at the numbers and they would actually trade off the numbers. Nobody cares. And it raises a question, at what point does it tip the economy? At what point does it actually matter for people where they put their money? Because right now it is mattering to small businesses. And I don't see what exactly is going to rescue that if people cannot leave their homes.
For markets, not much right now. We're down 1/3% on the S&P 500, just off all-time highs. Up next on this program, Vishy Thirupatur, Morgan Stanley Global Director of Fixed Income Research, on the year ahead. Got to get through December first. But 2021, you've read the outlooks, you're familiar with the crowd. We'll get into that next on this program. This is Bloomberg.
the big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Very serious reach for yield environment.
We still have a lot of bad news to get through over the next quarter or so.
The tea leaves have never been harder to read.
These payroll reports are getting overshadowed by positive news.
Certainly some support is going to be needed going forward.
What monetary policy could do, most importantly, is to support fiscal policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene is away. He'll be back tomorrow, and no doubt he'd like to talk about this. Red headline dropping across the Bloomberg, the UK ruling out continuing EU trade talks next year. That coming from a spokesperson. Lisa, you asked about deadlines. Well, according to the latest conversation, they won't be doing the talks about trade talks for much longer.
I love that you say that Tom Keene will want to talk about this, the implication being you do not. I find it really interesting, each headline that comes across. Right, I mean, that's the very, very not subtle subtext here as you talk about what is a deadline after all. Well, we're seeing
He's, of course, our chief Brexit correspondent, and he'll be interested in the headlines, as will many people in the UK and across parts of Europe as well. So we understand, according to a spokesperson, the UK ruling out continuing EU trade talks next year. The Prime Minister will be engaging with a phone call with the Commission President, Ursula von der Leyen, a little bit later on today. So that's the story for the market. Sterling lower for everything else. Not paying much attention to this whatsoever. Lisa, for the rest of the world, we've been focused on the headlines around the pandemic. For this market, it's a record high in the S&P, just off right now, down 1/3 of 1%. It's a record high in the NASDAQ. On the NASDAQ, we've had 8 days of gains. on the NASDAQ 100. On the Russell, we've had 5 straight weeks of gains. It's been rally after rally, week after week over the last month.
Well, and there's sort of a fundamental question here. How much can the wall of cash offset any issue, concerns that people have, both with the pandemic, the economy, but also not only with Brexit, we also got trade tensions overnight. We got more threatened sanctions on Chinese officials over Hong Kong disputes. I mean, to me, this sort of these were issues that people cared about a couple years ago. They don't anymore because there are fiscal support packages being passed. The Fed's on board. How can they lose?
Condition not to care. Point 1, the vaccinations start in the UK tomorrow. They could be approved in the United States by maybe Thursday. Point 2, faith in policy. Faith in policy that policy actually works because everyone believes it does work. Looking at financial markets, we've been conditioned by that experience. Pullback should be bought. That markets can be stimulated, that the Fed can keep financial conditions loose, even with a large slice of the global economy closed. That was the lesson of 2020. I don't know if you can extrapolate that out for another decade, Lisa. I know it feels uncomfortable, but that's the reason why so many people are piling behind this view into next year as well.
Yeah, I do wonder, though, if fiscal policy does not support monetary policy, does that wall of money run out in terms of its efficacy of propping up markets? Or does it continue and just get that much more divorced from the underlying economy?
Well, the good news is it looks like that $908 billion bipartisan stimulus plan is gaining just a little bit more support down in D.C., and the market believed that was the case after that downside surprise on a payrolls report. Well, Vishy Tirupattur agrees. Morgan Stanley's Global Director of Fixed Income Research joins us now. Vishy, up in risk, down in quality. That's the conclusion for Morgan Stanley. Why, Vishy?
Absolutely, and good morning both to you and to Lisa. And I think where we are is the tremendous amount of policy support that you alluded to that remains. Both we expect the monetary policy to remain extremely accommodative, and we expect more fiscal policy to come through, especially after Friday, and as you outlined earlier. So we think that we are in a place, supported by policy, the better than expected results on the virus front, all of that in combination, we think that it pays to keep the faith, trust the recovery, and go down in credit in both in credit and in equities, go down in risk assets.
That's been the mantra for Morgan Stanley coming out of spring, and you've been right. And if you have managed to keep the faith, as uncomfortable as it has been, you've been handsomely rewarded in markets for doing that. This note came from SocGen in the last 60 seconds. Vaccines are good for humanity and for the global economy's prospects, but they aren't good for the dollar. Are they bad for treasuries too, Vishy? Are vaccines bad for treasuries? And if so, how bad?
What we expect to see is a gradual pickup in the treasury rates, more in the 10 to 30-year point of the curve. So the front end is going to remain very anchored to where we are until well past 2021, possibly well past 2022. But that means that the 10-year treasury, we expect to see 10-year treasury and the 30-year part of the treasury curve to steepen. So our expectation at the moment is that over the course of next year, we'll see the 10-year treasury go from where we are today to 145 by end of next year. So this will be a gradual, not a taper tantrum like a spike, but a gradual increase in the 10-year part of the curve.
And is that the point, the idea that the pathway up should be slow and measured, and that is how the Fed is going to engage with the bond market going forward, to sort of buy on the margins, to sort of keep a lid on the velocity of the increase, if not the actual increase itself of Treasury yields?
Absolutely. I think the Fed has been very clear on that. They have the tools to keep the velocity, the financial conditions relatively stable. I mean, I think the thing that the Fed cares most about is the financial conditions, and we have all incentive for to keep the financial conditions very accommodative, and there are tools that the Fed can easily deploy. We're not expecting that the Fed will deploy any change in the weighted average maturities in this meeting, but that doesn't mean that the option doesn't exist for them. So there is more or that the Fed can do and are able to do. So we think the Fed will gradually allow rates to go higher, but without threatening the overall financial conditions.
So let's sit on that for a second. You don't expect the Fed at their meeting next week to change the duration of their bond purchases. Last week, Priya Misra of TD Securities said that if they don't, it could cause a taper tantrum because this is the expectation baked into markets. Do you agree?
I think the market had expected assigned a greater probability of a weighted average maturity extension, but we think over the course of last week or 10 days, the market has come to terms with that that may not be happening in this month. So we don't really think that the markets will be terribly disappointed here at this point. A lot is already reflected in price. Just because it doesn't happen in December doesn't mean it is not going to happen at all. It is going to be an option that the Fed will keep, and the market recognizes that.
Well, Vishy, there's another elephant sitting on the long end anyway, even if the Fed doesn't get involved. It's the ECB. We've got Italian 10-year yields down to about 60 basis points. The spread over Germany right now is about 128 because we're negative about 58 basis points over in Germany on the German 10-year. And people believe there's more juice to squeeze out of that spread because the ECB is going to keep piling in, Vishy, keep buying. And over a longer time period as well. That could be announced as soon as Thursday. And Vishy, I think many people in the Treasury market wondering just how high yields can go if yields are going in the other direction in Europe.
Yeah, I totally agree with that. Which is why we think that rates would be higher, but relatively measured. So where we are to 145 is certainly a meaningful move, but nothing I would say dramatic. We won't expect a spike here.
Let's talk about your allocation to risk then. We've talked about core government bonds in treasuries and a little bit on bunds there too. A BTP is part of the credit trade for you, Vishy. Is that part of the trade, taking that little bit more risk to get that extra return?
I think that is a part of the credit trade. I think even though there are better places to play credit, but I think there's certainly a part of the credit trade.
Where are the better places, Vishy?
We think the better places are on both sides of the Atlantic. The lower in the rating spectrum is better trade. We expect that we expect to see, for example, the investment grade. We prefer triple Bs over single As. The incentives for triple B rated companies to remain investment grade are substantially higher, and we think that the expectation that earnings will pick up meaningfully, that my colleague Mike Wilson has talked to you about, we think that the triple B companies are going to be acting in a much more credit-friendly fashion to preserve their investment grade rating. Similarly, as you go down in the capital structure in the credit spectrum, we like being overweight in the loans over bonds. Over the course of the year, as rates rise gradually, will have an effect on high yield performance of the back half of the year. We know that actually favors the leveraged loan world. So we like loans over high yield bonds, especially in the second half of next year. So overall, down in quality buys is intact, even though we have seen compression within the quality spectrum. We think there is still more compression yet to occur.
Vishy, always great to get you on the program, sir. Appreciate your time. Thank you. Vishy Tirupatur of Morgan Stanley on the outlook for 2021 on a fixed income side and a little bit on equity there as well. Lisa, loans over high yield towards the back end, factoring in the rates factor at some point for maybe the second half of 2021. Reach out to Morgan Stanley for more on that. High yield, the spreads have got more to run. The triple Bs and double Bs are still the sweet spot, that they found religion, the incentive to keep that credit rating and investment grade for the triple B complex. Lisa, spreads are already so tight, and I know you've been beating this drum now for the last several months, but they just keep getting tighter.
Yeah, and the spreads, meaning the extra yield that investors earn over benchmark rates, the tightest since February. But if you look at the all-in yield, it is the lowest on record for high-yield bonds. 4.39%. You got that in investment grade. If you take a look at triple Bs, 2.2%. That's a treasury yield, John.
Unbelievable. I did say that treasuries, the risk-free assets now investment grade and Investment grade now is high yield. Where high yield is, I don't know. Coming up on this program, Tina Fordham, Avonhurst Advisory Services Head of Global Political Strategy. We'll head down to DC in just a moment. For our audience worldwide, heard on Bloomberg Radio, seen on Bloomberg TV, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. One Republican senator predicts that President Trump will get on board with a bipartisan $908 billion package for coronavirus relief. Senator Bill Cassidy told Fox News that Senate Majority Leader Mitch McConnell will back it too. Cassidy is a member of the group that's pushing the measure. And President Trump's lawyer, Rudy Giuliani, has tested positive for the coronavirus. According to reports, he's been hospitalized in Washington. Giuliani's son says he's getting great care and feeling well. Giuliani has been leading the effort to overturn the results of the election. And in China, exports jumped in November by the most since July 2018. That pushed its trade surplus to a monthly record high, and it underlined how global demand for pandemic-related goods is helping the Chinese economy rebound. It's another potential blow to New York City's stature as the home of the U.S. financial industry. Goldman Sachs is considering plans to move its asset management unit to South Florida. Goldman's success in operating remotely during the pandemic has persuaded the firm's leaders that they can move jobs out of New York to save money. Universal Music is buying Bob Dylan's entire song catalog in what's described as a blockbuster deal. It's a collection that spans 6 decades and includes songs such as Blowin' in the Wind and The Times They Are A-Changin'. Universal's not saying how much it's paying. People familiar with the terms say Dylan's songs are worth more than $200 million. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
When you call somebody, any head of state in the world, how hard is it for you to get anybody on the phone? I assume not too hard.
I would say it's not too hard, but sometimes it takes a week.
sort of technology landscape gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're going to focus on those most vulnerable and those most on the front lines of treating people with COVID with the initial 40 million doses in the next month. And then we're just going to progressively keep adding more and more people. So be thinking in the February-March timeframe that you're going to see more general vaccination. And by the second quarter of next year, we'll have enough vaccine for every American that wants it.
And that's the timeline from Alex Azar, the US Secretary of Health and Human Services on ABC's This Week over the weekend. Live from London and New York this morning. Good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. The timeline for vaccinations, Lisa, get to the end of Q2 perhaps. The stimulus program, how many times we talked about this over the last 12 months? The stimulus program now is about the bridge to the end of Q2. And you and I have both said the same thing. We make the mistake of calling it stimulus. What this really is aid. It's an aid package to get us to the end of Q2. The stimulus, that's something you've got to think about after that.
I'm really curious to see the details of the plan. We're going to be getting it today, but I'm curious to see whether there are going to be any direct payments to individuals. The word is there won't be. How they get that aid out to small businesses. The details matter, John, especially as the pandemic is getting worse.
And will we get that $160 billion in state and local aid? Tina Fordham joins us now, Avonhurst Head of Global Political Strategy. Tina, let's just start with your read on negotiations down on Capitol Hill. It certainly sounds a lot more constructive over the last week or so. What's your take, Tina?
Well, I always get worried when it starts to sound constructive, because part of that, signal that talks are going well is in itself just reflects the political imperative for both sides to be seen to be working in the country's best interest during this time of crisis. Everyone uses the same expression, the devil in the details. I think the observation about this being aid rather than stimulus is a very astute one, because we forget how toxic the term fiscal stimulus can be in the U.S. context. So I am less optimistic, actually, now than I was the last time, but then I was wrong. So I think that it's going to be in Republican interest to be seen to be driving a very hard bargain, especially as we have this signpost of January 5th, the Georgia runoffs coming.
So what's the main opposition here? Is it still the state and local funding? Is that going to be the main sticking point?
I think that there is room for compromise, but that Republicans will be wanting to be seen to be driving the harder bargain. And one of the new twists that we've experienced since the presidential elections is Republicans finding religion again on deficit spending, right? So, or the size of the deficit. So they are not going to want to be giving in to Democrats, and that's why I worry that markets are getting ahead of the politics on this one, because we haven't had a lame duck session quite as contentious as this one is likely to be, and I worry that the scorched earth tendencies that we've seen thus far might actually bleed into the stimulus discussions.
I'm struggling to see where the deficit hawks are coming back into play here. I mean, even Mitch McConnell, he did propose a skinny bill. He did, there was talk about him signing on to the bipartisan agreement once the details were hashed out. President Trump seems amenable, open to the idea of signing off. Who are the deficit hawks?
Listen, I think that we've seen a different tone in Congress. I'm here in London talking to you about global macro. I think that the political imperative to get a stimulus deal done was there before the elections and was calling it for then. I'm worried that a contentious, particularly contentious and polarized mood where we haven't even got people willing to recognize the results of the presidential elections in the House gives a lot of wiggle room to say that, we want to do the right thing for the country, but we just can't get there.
Tina, you've mentioned the importance of language, that it's aid, not stimulus, because that word is toxic in parts of the country and parts of the politics of the United States of America. When you start to hear the word state aid, to another person, that's just a bailout of poorly ran states. And we've heard that so many times from the administration. I heard it from them directly on Friday. Now, Tina, I'm wondering from your perspective, is there any way that they can offer aid to states without that being considered a state bailout of what many Republicans and the electorate might consider to be poorly run states?
Well, to me, this is all code. You know, I'm an American who's been living outside my country for over 20 years. There didn't used to be this debate about which states were run well by governors of which side. So I'm really worried that we're even normalizing this discussion. This is the biggest crisis in decades in terms of its impact on lives and livelihoods. And to suggest that it's in any way rational or reasonable to do anything other than pass a stimulus right now, I think doesn't put the economic interests of the country at heart, which is why I was saying what I did about the return of fiscal discipline and, frankly, finding pretext to avoid doing what needs to be done. The United States, in a crisis where people are losing their lives, shouldn't be differentiated between poorly run states and well-run states that just happen to be led by a leader of a particular political stripe. So to me, this is a pretext to not do what needs to be done, what every economist, central bankers, have all agreed upon. This is getting held up in Congress.
Well, I think, Tina, I would go one step further. I think what totally exposes the intellectual inconsistency and the dishonesty in some parts of the debate is that those very same people who are unwilling to offer aid to what they consider to be poorly run states are also considering offering aid to airlines, which many people on Wall Street would consider to be poorly run airlines in the context that they had no cash when it hit the fan.
Yes, poorly run enterprises, shrinking enterprises, even dying enterprises. Absolutely. So I guess I think you might have struck a nerve. I'm just not willing to use the current terms to have this debate. This stimulus should be passed. In Europe, where I am, governments composed of many political parties are finding common cause, and we're seeing these things pass so that people can move on with their lives. And we have a few more months to go. Now, what really worries me about what's happening in the United States is we have, in some ways, the worst of all worlds. We haven't even had, kind of fully fledged lockdowns. They've been partial and they've been late. A vaccine, miraculously, or rather thanks to the hard work of scientists and epidemiologists, is coming. But we have many months to go before that rollout. And markets are very buoyant on the amazing news that vaccine is coming. But we could have many months delay, which is why I worry about what I call vax populi risk. The combination of weak state capacity, as in country, not individual U.S. states, but weak state capacity combined with anti-vax sentiment and, compounded by these kinds of delays in the stimulus that's necessary, could really make things pretty problematic in the coming months.
Some challenges still to come in the near term, that's for sure. Tina, thank you. Thank you for your time this morning. Tina Fordham there of Avonhurst. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Coming up on the programme, Daniel Arndt, the chief US economist of BNP Paribas. For our audience worldwide, heard on Bloomberg Radio, seen on Bloomberg TV on this Monday morning, with equities pulling back just a little bit. This is Bloomberg.
retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
From New York and London this morning, good morning to you all. For our audience worldwide, this is Bloomberg Surveillance live on Bloomberg TV and radio. And here's the price action for you. For all the talk of that rotation into the cyclicals, into the small caps, big cap tech, the NASDAQ 100, 8-day winning streak coming into Monday. This morning, futures unchanged on the NASDAQ. We pulled back from all-time highs on the S&P 500, down around about 1/31%. That's the stock market. Switch up the board and get to the bond market just quickly. 2s, 10s, 30s. Just give you an idea of the Treasury curve this morning. Last week, steeper, yields up. This morning, flatter, yields down about 3 basis points on 10s to 0.94%, on 30s to around about 170. On Friday, downside surprise on a payrolls report. The read across, more chance of getting stimulus down in DC. The talk, well, it's supply concerns weighing on the Treasury market. That's too narrow. What's much, much more important is what that supply does to economic expectations, inflation, growth, rate expectations further down the road as well. That's the story. Supply alone in a core government bond market like Treasuries won't lift yields. You need more than that. You need better growth. With the idea that we look at Italy as an example or Greece, I'll show you Japan. Switch up the board and get to the FX market. Just briefly, I'll finish on this. We talked about it enough over the last 90 minutes or so. You know where I'm going. Sterling weaker, cable lower, 133 handle. Started the day with 134, had a sneak peek at 132. Lisa, you know what the conversation is. Talks continue, but they won't continue into the new year on trade. We learned that about 30 minutes ago or so. I don't know if that gives you any more clarity on where these talks are going. After the Sun reported earlier this morning here in the UK, a tabloid newspaper, that the Prime Minister was ready to walk away within hours. Well, several hours later, we learned that actually he'll be having a phone call with the European Commission President Ursula von der Leyen a little bit later this afternoon in Europe. So the talks about trade talks, well, they Lisa, continue.
Yeah, and it's exhausting, the Brexit discussions. You know, it does have a real-world effect.
Do I sound exhausted? I think I'm exhausted, and I've managed to ignore it for much of the last 4 years, and I'm exhausted by it.
I know. We're all exhausted by it. We're exhausted by the pandemic, and these have all been a double whammy for cities like London and for New York. And it's not just Brexit. With respect to London, and London Mayor Sadiq Khan was on Bloomberg Television earlier this morning, but this idea of cities being cleared out and high-cost cities suffering disproportionately. Goldman Sachs said to be weighing plans for a new Florida hub to house its asset management division. Sonali Basak, Bloomberg Wall Street reporter, joining us now. Sonali, is Goldman Sachs is sort of a harbinger of what's to come for New York City for the financial industry?
Right, Lisa, you already see this happening at a lot of big asset managers. Think Blackstone already amping up its presence in the city of Miami. You have Ken Griffin as well. So it's been happening for a while, but Goldman Sachs, remember, is a bank. It has much more than just an asset management division. And if we see more parts of the financial industry start to move down there, then the question is how much of the industry moves out of New York City.
Sonali, I think what it comes down to, though, is not the end of cities, it's the end of expensive cities. That's the debate. And I'm not saying we're at the end, but that should be the conversation, right? Because as you know, Sonali, over the last few months, everyone's been talking about, will the cities ever make a comeback? Will New York ever come back? The conversation we're having right now is not the end of cities. It's about what happens to the really expensive ones, like the one I'm in, London, like the one you're in, New York.
That's exactly the question, John, because we're not talking about them moving to the middle of the country. We're talking about them moving to above Palm Beach County, right? We're talking about them moving to Fort Lauderdale. We're talking about them potentially moving more employees over to Dallas, Texas. Another city I ask a lot about is Denver, because you see so many tech titans moving there as well. A lot of this is about taxation. If your employees live in a lower tax base, then do you need to be paying them as much money? And on top of that, you can be paying less for your real estate as well. So you're absolutely right. This is not about the death of a city. This is about how a city manages through a tough time and whether there will be that flight from the great New York City that we have not seen despite all the risks that have come up in the past.
Sonali, just quickly, you speak to the people that work at these banks at all levels of the bank, the asset managers as well. When you speak to the people that aren't making the management decisions, do they want to go to Nashville? Do they want to go to South Florida? Do they want to go to Denver?
Not everybody wants to move everywhere, John, but what's remarkable is some of this push is coming from the employees themselves. That's certainly true for the asset managers, but we don't know whether that's going to still be true for the investment bankers. Your investment banker, your classic investment banker, I was talking to one just this weekend that was spending all of his time in his Florida home. Why? Because that's where his clients were. So as more of these asset managers move there, you see more of a reason also for Wall Street to join them.
Sonali, great work, as always. Always enjoy catching up. Bloomberg Sonali Basak there on the latest with this big move potentially away from the likes of New York City. Lisa, this is a conversation that existed before the pandemic, and I think it's really important to highlight that, as we just have done.
Yeah, and Goldman Sachs actually had a plan in place that they were vocal about, trying to move some of their employees away from high-cost cities. And they said, you know, that this is a continuation of that, and yet you do wonder if this is accelerating because of the pandemic.
The return to normal, what does normal even look like? Let's bring in Dan Ahn, BNP Paribas Chief US Economist and Head of Macro Strategy. Dan, we keep hearing that. Vaccinations coming, back half of 21. It's about the return to normal. What's normal in the conversations that you have? What does normal sound like in the back half of 21?
Yeah, normal, thanks for the question. Normal probably means a growth range a lot closer to long-term potential in the 2 to 2.5, maybe 1.5 range, but not the eye-poppingly large double-digit annualized 30 plus and 30 minus type growth that we've seen before. But I think beyond just the simple numbers, though, it's a real question as to not so much what happens to demand. We think that a lot of demand will try and renormalize, but where are the areas where supply is going to have to adjust to a new reality that demand is never going to come back? we were just hearing about people's locational preferences. Does this mean that demand for high-end luxury condos in Manhattan is going to change? Does this mean that people's business travel is going to change? Does this mean not just a fall in demand, but does this mean that demand for digital services is going to be at a new permanent high? A lot of companies are going to have to adjust to this, and while this is opportunities for some, these are challenges for a lot of others.
And it raises a question about inflation. How do you measure inflation in a fundamentally changing economy into one that is more dominated by tech? What do you see in terms of inflation picking up, and how should we be measuring it?
Yeah, well, the classic ways to try and assess where inflation is going is, of course, looking at the measurement of output slack in the economy. And we actually just released our latest global outlook, where we see technical measures of slack in the economy close by the end of 2022. So we do actually see a bit higher inflation coming, putting aside denomination effects starting in late 2022, early 2023. But really, is how widespread is this going to be? Is this going to be a general move higher in inflation across the overall economy, or are we going to see parts of the economy still in the doldrums while others are red hot due to more demand? I think that's going to be and is that going to translate into higher wage pressure more generally, or again just in a few segments of the labor market? I think that's a big question that actually the new administration will be asking themselves.
And it's also really hard to even imagine, if you think about some of the fiscal support plans and the checks that have been sent out to individuals. I mean, if the government were to engage in another round of helicopter money, essentially, would that fundamentally change your view on inflation in the United States?
No, I don't think it will fundamentally change it, but I do think it will certainly ward off some of the risk that we could fall into a deflationary trap. I think inflationary expectations, at least as you measure them by market break-evens, they're kind of teetering on the edge of potentially moving lower if this does look like there's going to be lasting scars in the economy. And so the big recovery in break-evens that we've seen in the last couple of months is, I think, out of hope that the scars will be less damaging as the vaccine is around the corner. Yeah. But the question is, can there be enough fiscal support to tide us through this transition until the vaccine arrives in a way that will continue to support inflationary expectations in the future? So I think that's probably the most important way in which just this immediate fiscal support can nevertheless have long-term impacts upon the economy.
Well, Dan, let's make it really simple and just wrap up with this. And I think this is why the 250,000, that kind of number in payrolls like we got last week, is so important. How many jobs do we need to actually generate to actually fill the gap of the last 9 months, Dan? And how long would it take at a rate of 250K to get